Margie, your point late last week was that forward guidance is working in terms of the tightening of conditions, and the market's baking that in well ahead of what Fed funds itself has to do.
Yes, that's right. The Fed has talked a very tough game, and I think maybe they hoped that the market would do their work for them. They wouldn't have to raise rates so quickly or so often. But I think the market has gone a little ahead of itself, and now people are genuinely fearful of all the Fed's talk about continuing to raise aggressive liquidation, raising funds rate by a point, and they really have scared the market to death. And if they would pursue on that path, I think, in fact, you would have the beginnings of the recession late this year or in 23.
So what parts of the market do you think have overcorrected into the value side?
Well, I think there's been a lot of overcorrection, but I think there are two parts of the market. Price-earnings ratios for the whole market has come down maybe 4 or 5 turns, but those specific sectors that did so well during the growth phase, that is small tech, small biotech, small tech with no earnings, the SPACs, the most speculative parts of the market that did so well are collapsing, not because of rates going up, but simply because people are looking at the fundamentals and saying these companies simply don't have the fundamentals we thought. So those are the sectors that have really gotten pounded. I don't think they're coming back. I think it's all the rest of the market that's got value priced, and that's where we're looking to find the most attractive places.
John, how should we think about the earnings outlook? Because we were talking about how valuations have certainly come back toward the neutral zone, but that depends on earnings coming through in the second half. And obviously, we're getting some of these consumer companies downscaling what they expect. So where do you think we're going to land there?
I think we'll probably land a lot better than what people think, Mike, just as in this last quarter. You know, for Q1, people don't even talk about Q1, and earnings in technology were up 10%, as I recall, on back of revenue growth of about 12%, and that's with the vast majority of companies having reported. And across other sectors, my recollection is off of the top of my head that 9 sectors are reporting positive earnings, and all sectors, and some, mind you, very little, I think of communication services, reporting a positive revenue growth. So I think, just like you said a minute ago, I think we got to look at revenue growth. It's a good forward indicator. And where we are right now, whenever the Fed is in the start of a Fed funds hike cycle, people get out of line with projecting negative things. Whether you go back to 2009, which was a recovery period parallel to this, or whether you go back to 1994 and things worked out.
Yeah, I mean, there's no doubt things worked out. I do think, though, that, you know, maybe the market is telling us that it has to get to cheap as opposed to just fair, John. I just, you know, if you look back at where we bottomed, and you had the 2018 sell-off in early 2016, you did seem to build in a little more of a valuation cushion. So do you think that we might overshoot in that direction?
Well, yeah, I think we likely will, although, you know, the forward handle on the S&P as of last Friday was 16 and change, and I think it was headed towards 15 at one point. We've got to consider that the forward valuation has come down, and not just on the S&P, but if you look at the mid caps, the S&P 400, the S&P 600, which is a higher quality, and even the Russell 2000. The multiples have been coming down at levels that are going to be regarded as very attractive, we'd have to think.
Hey, Margie, in terms of global growth, I wonder what you think of the risk of defaults in emerging market debt, dislocations that can happen with the market's legs a little bit wobbly, not necessarily recessionary, but definitely weaker than before.
Yes, well, what's interesting about this cycle is, one, we're entering this fearful period at a time where the U.S. economy is very well balanced. We don't really have any sectors that are worrying, unlike other parts of the world. Emerging markets are loaded with debt, mostly highly dependent on China. China's growth has slowed down. And in fact, I believe that thanks to COVID and some other things, our growth is actually going to be exceeding China's growth, showing you the strength of the economy. And really, around the world, there's so much going on, most of it negative. That says to me that there's a lot more risk as far as earnings disappointment and economic growth, and the risk of defaults, which we've already started to see pop up in the emerging markets. Makes the U.S. look pretty good.